company has plant costing 500,000. It's only been purchased beginning of the current year. Depreciating it over 10 years for accounting and 5 years for tax. So the carrying value is going to be, end of the first year, what's it going to be? 450. 450,000. Okay, so 500 divided by 10 is 50, so the depreciation in the first year is going to be 50. So 500 minus 50, this is the net value. Okay, so the plant is sitting at a net value or carrying value of 450. This is the accounting value. Obviously this is tax. Tax base is going to be? Okay, 400. 500 divided by? It's depreciated over 5 years for tax. So 500 divided by 5 is 100. So the tax base is going to be 500 minus 100. 500 minus 100. Okay, we've said that for assets, if the carrying value is greater than the tax base, it leads to a taxable temporary difference, yeah? Which results in a deferred tax liability. Okay, so we know that the taxable temporary differences lead to a deferred tax liability. The deductible lead to a deferred tax asset. Okay, we know that this is carrying value is greater than tax base. Therefore, it's going to be a difference of 50, and it's a taxable difference. Okay. Okay, so we've done the first thing here. The next thing they say is there's interest prepaid of 60,000. So interest prepaid, there's obviously an item on the balance sheet. Okay. Interest prepaid is 60. So carrying value in the balance sheet is 60, and the tax base will be 0. Okay, why 0? Why 0? Prepaid, yeah? It sure is. What's the reason why its tax base is 0? Because it's prepaid, you're right, but we don't have any prepayments for tax. Why not? Because we run according to a cash basis. So we don't have any accruals, we don't have any prepayments, and we don't have any provisions. Okay, if you have a cash method, then you're not going to, you're basically working according to what cash has been received, that's your income, and what cash has been paid, those are generally your expenses. Okay, that's generalizing, but that's the basic concept. Okay, so we've got 60,000 being the interest prepaid, 0 for tax, and this is obviously going to be an asset, or it is an asset. So we have a carrying value greater than tax base. We therefore have a taxable temporary difference. Okay, correct me if I'm wrong. And so we've done that one. The last one is provision for warranty of 30. So your warranty is 30. Okay. This is a liability. And we're going to have carrying value greater than tax base. How do I know that? What's the tax base going to be? 0. Why? Provision. We don't have any provisions. Okay. So provisions are 0. Therefore, the temporary difference will be. It's the opposite of this. So here, if carrying value is greater than tax base, we're going to have a deductible temporary difference. Basically just the opposite. of that. So we're going to have 30,000 here. And that's it. We haven't got any more. What do we do now? Basically just add these up. 30, 110. What do we do now? Sorry? Yeah. Okay, that's going to be? This is going to be? No. Okay. Yeah. And basically, based on that, assuming there is no opening balances, this is going to be 9. Deductible leads to deferred tax assets. Taxable leads to always deferred tax liability. Okay. And this is going to be? And therefore, tax expense will be? 24. And debit or credit? Debit. Okay. If I said to you that there is opening balances, so opening balance, deferred tax asset, deferred tax liability, this is 10, this is 8. Okay, what's going to change here?
Sorry, just repeat that.
Okay, so we've got opening balances. Deferred tax asset, beginning of the year was 10,000 opening balance. This is opening balance of 8. What are we going to do? How is this going to change? Is it going to change?
Yes, because we want that's the opening balance, and we want to subtract it off the final balances.
Yeah, that's right. So basically, am I putting the right thing here? No, I'm not. It should be 8. Okay, so the closing balance must be that. Okay, so when we do this table and we work this figure out here, that's got to be the closing balance. So for deferred tax liability, 33,000 must be the closing balance, and for deferred tax asset, 9,000 must be the closing balance. Okay. If we've got opening balance, why do I say that that's got to be the closing balance? Isn't it just for this year? Are we taking differences for just this year, or are they differences over an extended period that we're calculating? Sorry?
Just for current year?
They're actually not, because if you think about it, you know, your plant can actually have accumulated depreciation for a number of years. Yeah? These are closing balances in your balance sheet, closing balances. And they're closing balances taking into account all the years that have gone before. Okay? So if you're taking the difference between these closing balances, what you're working out is what the closing balance must be for deferred tax. The differences aren't just for the current year. They're not differences that have occurred only this year. There are differences which kind of extend beyond this year. Okay, so don't worry too much about that. Just remember that this figure here must be the closing balance. If you've got an opening balance of 8, deferred tax liability, therefore, this is going to now change to what? 25, yeah. So you take off 8. This year, what's going to happen here?
It's going to be a credit.
It's actually going to be a credit, because you're actually, if you want the closing balance to be 9 and it was 10, you're actually going to be taking off 1,000. So in fact, this should actually be credit. Deferred tax asset. And what you're actually going to do to make it kind of make more sense is you're actually going to probably do something like this.